Are you ready to start investing but not sure where to begin? Don't worry, you're not alone. With the new year bringing new opportunities, now is the perfect time to take control of your financial future. In this video, I'll break down the best investments for beginners, step by step. Whether you're looking at stocks, real estate, or even crypto, I'll help you understand where to start and how to grow your money wisely. So let's dive in. 1. High-yield savings accounts. Okay, a savings account isn't technically an investment, but rates continue to be high, even following a series of cuts by the Federal Reserve. So high they've earned a place on this list, especially for folks who have a short-term goal or don't want to take any risk. Online savings accounts and cash management accounts provide higher rates of return than a traditional bank savings or checking account. Cash management accounts function as a hybrid between savings and checking accounts, often providing competitive interest rates and added features like debit cards or checks. If you're new to saving and investing, a good rule of thumb is to keep 3 to 6 months worth of living expenses in an account like this before moving on to other investments. 2. Mutual funds. If only there were a way for someone I trust to do the research, management, and investment decision-making for me. If you've thought that before, today is your lucky day. A mutual fund is a pooled investment. Think of it like carpooling. Everyone in the car contributes towards gas money, but only one person drives. Similarly, investors pool their money into a mutual fund, and a professional money manager makes investment decisions on their behalf. Mutual funds are one of the easier ways to diversify your investment portfolio, since money managers can use pooled money to invest in stocks, bonds, or both in major asset sectors on your behalf. 3. Certificates of deposit. A certificate of deposit CD is a federally insured savings account that offers a fixed interest rate for a defined period of time. Now may be a good time to lock in that fixed rate since, unlike a regular savings account, CD rates won't fluctuate if interest rates go down. A CD is best for money you know you'll need at a fixed date in the future, e.g. a home down payment or a wedding. Common term lengths are 1, 3, and 5 years, so if you're trying to safely grow your money for a specific purpose within a predetermined time frame, CDs could be a good option. It's important to note, though, that withdrawing money early usually incurs a penalty. So, as with other investments, avoid putting money in a CD that you might need soon. 4. Real estate. Another fun investment for beginners is real estate. Many new investors have heard that real estate investing is the way to generate wealth, but the thought of buying and managing properties can be intimidating. Owning your own income-generating property is one of the best long-term investments you can make, but it's not the only option anymore. A beginner-friendly approach is to invest in real estate through platforms like Fundrise, which allows you to buy shares of income-generating properties. 5. Government bonds. Bonds can offer investors a relatively safe form of fixed income. A government bond is a loan to a government entity, such as the federal or municipal government, that pays investors interest over a set period of time, typically 1 to 30 years. Because of that steady stream of payments, bonds are known as fixed income securities. Government bonds are virtually a risk-free investment, as they're backed by the full faith and credit of the U.S. government. The drawbacks? In exchange for that safety, you won't see as high of a return with government bonds as you might with other investments. If you were to have a portfolio of 100% bonds, as opposed to a mix of stocks and bonds, it would be substantially harder to hit your retirement or long-term goals. 6. Corporate bonds. Corporate bonds operate in the same way as government bonds, except you're lending money to a company instead of the government. Since they aren't government-backed, corporate bonds carry more risk. High-yield bonds, also called junk bonds, can be particularly risky, resembling stocks in terms of risk and return potential. Corporate bonds are best for investors looking for a fixed income security with potentially higher yields than government bonds and willing to take on a bit more risk in return. Generally, bonds from financially stable companies offer lower yields, while riskier companies offer higher yields. It's up to each investor to determine their ideal risk-to-reward balance. 7. Money market funds. Money market mutual funds are often confused with money market accounts, but they are different. Money market funds are investment products that buy high-quality, short-term debt from governments, banks, or corporations. These are best for money you may need soon that you're willing to expose to a little more market risk. Investors also use money market funds to hold a portion of their portfolio in a safer investment than stocks, or as a holding pen for money earmarked for future investment. While money market funds are technically an investment, don't expect high returns, as they function similarly to high-yield savings accounts. 8. Automated investing. Automated investing is the practice of setting up a system where a predetermined amount of money is regularly transferred from your bank account to investment accounts on a scheduled basis. This allows you to invest automatically without manually placing each trade, making it a popular choice for building a long-term portfolio with minimal effort. A major advantage of automated investing is its ability to create diversified portfolios across different asset classes, spreading risk while maintaining steady growth. Another benefit of automated investing is that it encourages consistent contributions, promoting strong saving and investing habits. There is also the factor of saving time by eliminating the need for manual trades and market tracking. Lastly, automated investing has become very accessible as many platforms offer user-friendly interfaces, making investing more approachable for beginners. While automated investing has clear benefits, I believe beginners should first take the time to learn the fundamentals of investing. Relying on automation too soon can limit your understanding of financial markets, asset allocation, and risk management. By developing a strong foundation first, you'll be better equipped to make informed investment decisions, whether manually or through automation. 9. Index funds. Index funds are a simple, low-maintenance way to invest. These funds track major stock market indices like the S&P 500, NASDAQ 100, Dow Jones Industrial Average, and Russell 2000. Index funds are great for diversification because their value comes from the performance of hundreds of stocks within the index. One of the most time-tested investing strategies is to put 70 to 80% of your money in an index fund, hold it for 30 to 40 years, and retire wealthy. It's not sexy, but it works. 10. Retirement investing. Unlike the other investments on this list, this isn't about a specific asset. It's about a long-term goal, retirement. Planning for retirement means making the right investments 30 years in advance. If that sounds overwhelming, don't worry, I'll make it simple. One of the best ways to invest for retirement is through an individual retirement account, IRA. The benefit of investing in an IRA is decreased tax liability. In a traditional IRA, contributions are pre-tax, and thus you have more money to work with right now. This means that you lower your taxable income now, but pay taxes when you withdraw in retirement. Another option is a Roth IRA, where contributions are post-tax, meaning you pay taxes up front, but your money grows tax-free, and therefore you owe no taxes when withdrawing in retirement. And that's it, your beginner's guide to investing. I hope this helped you feel more confident about where to start. If you found this video helpful, don't forget to like and subscribe for more investing tips. Let me know in the comments which investment you're most excited about. Thanks for watching, and I'll see you in the next one.